Live again like we are every Wednesday, and today the office in here is a bit echoey because we cleaned it all out, so there's nothing in here, so apologies for the echo on that. Today was a bad day in the stock market. It turned out, it started out pretty well. The morning had some decent names were up. Baba was up, PayPal was up, a bunch of stuff was up, and then by the late afternoon, it was just everything was crashing down. It was just a horrible afternoon. By the way, if you're getting the invitation, just hit the like button and let me know in the comments what's up with you guys. Today was a good day because I got the refinance on my house that I just purchased, so that was great. Had to buy it in cash and then was able to refinance it. It has been a full burr already without doing anything. Literally bought it and now refinanced it for enough that I can pull almost all the down payment out of the property tax-free, which is the cool thing about your primary residence exemption. You get to not pay any tax on that, which is kind of cool. Oh, there you go. Yeah. If you guys have any questions, by the way, throw them down below. I do have my brother over, and a previous mentee, a good friend, is over as well from Ottawa. So I'm gonna keep today's episode a little bit short, but what's been going on in my world's been been focused on getting my properties sold, fixing some of them up to get them ready for sale, and then obviously renovating my own place, and just mostly cosmetic stuff. But it just sucks. And whenever you're doing renovations, it sucks to live through it, especially if you have, I have 3 kids, 5 and under, and a dog, and everything else going on. So it's just a lot of things all at once. So that's been consuming the better part of my week. Stocks have been horrible. The last 7 days, I'm down 200 grand on my options portfolio. My blue chip, dividend portfolio, it's down also, but not near as much. Just brutal. Been a brutal couple of weeks for, like Alibaba, PayPal, a lot of pretty much every tech name you can think of has been beat up. Gaming tech too, been beat up. Just in general, been a really rough month. Usually you see November being, relatively strong, and then December a little bit of a sell-off dip, and then in January you tend to see a seasonal, sort of boost. But there's no way to really forecast or plan anything. I unfortunately am too heavy in a few select names. One of those names being SAM, Boston Brewing Company, and the Boston Beer Brewing Company is just down I think highs of 1,100 a share down to lows of 430 a share. Just brutal. I'm getting slaughtered as I average down that. My average cost base is probably somewhere in the high 500, so not too bad, but yeah. I don't know why, but my I don't see any chat, and for some reason I can't even see. I see 5 likes, but I see 0 people in the stream. It jumped from 20 to 0, so I'm not sure why. On my end, I'm having some glitches with streaming. It could be that I need a new phone and the YouTube app's just glitching out. And by the way, apologies for the drilling. They're trying to fix the level of the floor right now. So he's really grinding with a belt sander concrete on the other side of this wall, so we put the new floors in and it'll be nice and smooth between the 2 rims. So just a tedious, crappy task, but that's what you're hearing right now. I don't know if it's picking out because the room is completely empty right now. There's probably a lot of echo with that. As you can see, there's literally there used to be a bed here and stuff, and we took all that out. So it's kind of just my little office here. A little office in the basement where I've been doing the streams from. I got the kids running around like animals upstairs, so I can't quite pick any of the rooms upstairs. Usually it'd be fine down here, but of course trying to get things fixed up and got people working here. I probably have someone. We had the plumber fixing something. We had an electrician here fixing something from Reliance. That starts at 8 in the morning, and usually the work doesn't finish till 11 o'clock. So there's someone in my house at all times from 8 in the morning to 11 p.m. So that's what I'm living with right now. This part of, fixing things up. And Karan says volatile markets for sure, trading through history. Yeah, I mean, it's tough. A lot of days like today, I look at my portfolio and I think I should really be trading, I should just be picking really far out of the money put spreads with tight bands where my losses are super defined and I don't have to worry about like, those major loss days, right? Because you could build a portfolio, mind you, your growth would be limited, but you could build a portfolio quite easily where you could make 1% a month and have almost no downside. Like you could stop out with spreads on, even if you were shorting stuff, you could do super tight bands, or even if you're long on the market, you could do super tight bands, create good amounts of cash flow. This light sucks. And create good amounts of cash flow and still have, there we go, and still have, a decent amount of upside without, the problem is you're not gonna get those home run plays. So I don't know. I go back and forth. I feel like part of me just wants to be long on a lot of these companies, and I love just chasing premium too, and that's something that I gotta tone back. I gotta really watch my sizing on my positions. As an example, like Sam right now, because I've averaged into that like 6 times now, I think it's like a 15% of my portfolio, which is disgusting. Like I don't even like the company that much. I don't even know how they became like 15 or 17% of my portfolio right now. But it's just one of those things where like I continue to average down, wasn't watching my sizing on my positions, did a bit of day trading with it where like I was short it and long it at the same time, spread trading it, and then I sold one of the legs off and ended up getting assigned. And like I should have dumped the shares, but because I was down, I'm like, oh, I'm gonna hold until it recovers. And then it doesn't recover, and you're stuck holding it as it like continues to drop 25%. I should have stop lossed out, didn't. So just a lot of that getting away from fundamentals. I wrote myself an investor profile statement. I wrote myself a plan. I was like, this is how I'm going to trade options. And I just didn't do it. I'm like, I'm gonna have no position more than 2% of my portfolio. It's a great rule, I should stick to that. I'm not going to, when I've realized that my thesis is wrong, whether I was, take ego aside, you have to accept that you're wrong and cut your losses. The most important thing is to never lose. And yet here I am ignoring that rule and holding on as it continues to drop. I should have stopped out and evaluated. I can always get back in again. But position sizing is key, risk management is key. I have suffered a few losses and really let my ego get into things. And that's a mistake, right? Like you guys know what happened I was right with Newegg when I shorted them. My timing was all wrong. So, I was right. It did crash from $70 a share down to a low of $12 a share. Sorry, my 3 kids are literally playing right above me in the great room, just like smashing around riding trikes. So if you guys hear that, sorry about that. It is what it is. What was I saying? Talking about like the trading portfolio. I really could shift right now to, and I won't because I want to see these plays through. One of them is PayPal. I sold naked puts on PayPal, and I'm going to assign it $200 or a little bit under $200, like 192-ish or 195-ish a share. To double check on my cost basis, but like I'm going to hold that because I'm long PayPal till they're like 240, 250 a share. I like them as a company. I have a lot of other plays like that I want to see through. I could cut my losses right now and take like an $80,000 loss, just sell up everything I have in PayPal. But no, I'm going to hold and sell covered calls and generate some income on it until it turns around. But I should be sizing this a lot better. I've been terrible at position sizing lately. And reflectively speaking, as I journal this to you guys, I'm thinking to myself, geez, I'm not following any of the rules that I set for myself. And that's a big problem. I need to stop chasing risk and start focusing on I'm chasing premium and I'm not focusing on my risk, managing that. So it's an issue that I'm working on. Yuri says, wasn't there a strategy when you make money most of the time, no matter which direction the stock market goes in? Yeah, so there are strategies you can definitely play where you can pick tight bands on your puts. You can, as an example, you could sell like a bull put spread and you could be 10-15% out of the money, and you could have a really tight window where like the market have to fall 15%, but if it fell 17%, you'd be stopped out. So it'd have to fall exactly like 16% for you to lose any money. So you don't make as much, right? Because you've bought in that put and you're far enough out of the money, there's not a lot of premium there. So you're capping your upside to like 1% a month, which is fine. Like I was trying to shoot for the moon, right? I'm trying to get like 20, 30, 40, 50, 60% annualized returns. And in doing that, I took a ton of risk and ended up, shitting the bed a little bit on my portfolio. As you guys know, I shaved, so I was actually back up to past where I was on those neg losses. And then tech fell a lot. And my entire portfolio really, honestly, since about mid-November has dropped, well, I have a big portfolio, but I'm down 4 or 5%. And part of that's leverage, part of that's making bad decisions, but like 4 or 5% is not a lot, but on a portfolio my size, it's multiple six figures. And that hurts. To drop like $250,000 is painful, right? Yeah, it's psychologically it messes you up. So you want a dollar cost average. You're like, wow, it was a great deal at 200, but like at 175 a share, it's a really great deal. And you got to remember not to buy the dip sometimes. So it's a weakness of mine. I will come back like 2 months from now. I'll be back to break even again. And I think at the next time I'm in a bit of an upswing and I've seen these trades through into January, I'm going to probably switch to a much more passive strategy. I'm going to give that strategy a try. I started this strategy in April, and so I'll see about 9 months of that strategy through, see how I did, and then I think it's key to, I think that's when it's going to be a good time for me to test out this new, more passive strategy and just see how I enjoy it, how I like it. I think I'll sleep better at night. Daniel said, and hey William, good evening to you as well. Daniel says, how would you explain the wheel option trading you use at a very basic level? I've done it before on the channel like several times in the live streams. I've explained it, but effectively the idea is like, let's say you like a company and you want to own stock in them, and let's call it like, Bank of Montreal, like a basic bank stock or something, and they have like a 5% dividend yield, and you're like, I'd like to own shares of BMO at $90 a share. But let's say it's trading at $100 a share, hypothetically speaking. And you're like, I just don't want to pay $100 a share. I'd be happy paying $90 a share. So what do? Do you just sit there and wait till you can buy the equity? No, you use options. So you definitely take all of the, you can go look at all the different strike prices, but you can go out there and what you'll see is, let's just say like a month from now, you could grab, 90 puts, and you could sell puts, which means that you'll set a period of time, so let's say it's 45 days from now or something. You say 45 days from now, if it's $90 or below, I will take assignment. I'll let someone put those shares in my account. So you'll sell a put. And that's a way to effectively buy the shares at $90. If BMO falls to $90, you'll get assigned, but you get a premium for that. So they might give you $1 a share, let's say. So now you're going to get assigned shares at 90, but you get $1 a share for writing that contract. So your cost base is 89. But if the shares stay, say they're at 100 now, if they stay at 100, you get $1 a share for free. So now you just made $1 a share for nothing. So that's the whole like selling put idea. Someone on the other side of that contract is buying a put because they probably own shares in BMO and they're worried that their shares might dip in value. And so they want to be able to put those shares in someone's account. They want to buy a little insurance. And so when they're buying the put that someone else is selling, they're basically buying insurance on the portfolio. So you can buy a whole portfolio of stocks and then you can decide to buy some insurance on that. That's a way of making it less volatile. So if you have a nice equity portfolio of dividends, you could take some of your dividend gains or some of your appreciation and buy puts. That's another way to protect. So if the market drops 10%, guess what? Your puts are all way in the money. You could then close those contracts out and have a pile of cash to then dollar cost average down on those positions. Another way to protect your equity is on the call side. So you can have shares, if you buy calls, you can have, the way I think of it is you can have shares that you can call upon if you need to. And the same way, if you sell a call, you'd be short the shares if you then get assigned and the stock has moved away from the strike price. So there's puts and calls. Running the wheel is simply taking, you pick a stock you like, let's say, and pretend to wheel that stock. So that stock is BMO, you'd sell a put on it, you continue to sell puts on it. You might do it 10% of the money, you might do it at the money meaning at the current share price. So if it's $100 a share, you could sell puts at $100 a share. You might get $2 a share in premium. So you're getting to buy those same shares that you wanted anyway for a 2% discount. Very common that you can just buy shares that you would have bought anyway using puts to buy that same share for less. So I always like using puts, unless you think the stock's gonna shoot up tomorrow, you always use puts to buy shares that you wanna buy in companies. So whenever you're buying equity, you use puts to acquire those because you get like 1 to sometimes 10% discount on the shares that you wanna buy. So why wouldn't you sell a put to get the shares, especially if it's a stable stock you don't think it's gonna shoot up tomorrow, right? On the other side, so once you're assigned, you now have the shares. That's the first part of the wheel. You've collected a nice premium. You've gotten those shares at a discount. Maybe it took you several put contracts to get assigned. Maybe you got a bunch of money for nothing, a bunch of free money as you sold insurance contracts on that share until eventually those shares got put into your account. And then the second part of running the wheel is you now have those shares in your account. Instead of just selling those shares if you don't want to own them, you can say, hey, I'm okay to get rid of these shares at BMO at 120 a share. I got them at 90, but I'm okay to get rid of them at 110, 120. So you go then sell a call, a covered call on the equity you've now been assigned. You run the wheel and you sell a covered call. If you're running the wheel in an efficient manner, you would sell it closer to the money because you want to get rid of those shares. You don't want to have that equity. It ties up a lot of your margin. You'd rather have options contracts than actually own the equity because the equity takes a lot of your available gunpowder, a lot of your available margin. So you would sell calls at, say, let's say you just got assigned at 90 and you got a $1 or $2 premium, so your cost base is like 89. You might then sell calls at 90 and make $2 a share. So now your shares get called away next week on BMO because you sold calls on it. Your shares get called away and boom, now you made like $1 on the puts and $2 on the calls and you're all good. Where the wheel can go wrong is you run the wheel on garbage stocks and you get assigned the stock and then it just crashes. And you did sell calls on it, but it'll take a long time selling calls to get them assigned and pulled away at a price that is break even. So where the wheel doesn't work so well is in a really like a crashing market, because you get assigned a bunch of equity, you'll be stuck with that equity. You'll get the premium from selling the calls and eventually you'll get back to break even. You can run the wheel on a stock until you're at break even. So even if you buy a garbage stock and it crashes a ton, you can still wheel your way out of that. That's what I love about the wheel is you're not just stuck waiting for the stock price to like come back to break even. You can literally just sell calls for a year on monthly contracts and after 12 months, you'll probably be back to break even, right? So, yeah. Next one here. Happy I raised a ton of cash into last week. The market breadth had me worried. Yeah, I mean, there's this new, Omni variant or whatever, Omicron or whatever you call it. I'm not really following, to be honest, just noise. It sounds less deadly than before. It's entirely transmitted by vaccinated people that are traveling. So everyone's like, oh, now who do we blame? We can't blame the unvaccinated because it's all us vaccinated people that are traveling. So we're the ones spreading it. Wow, turns out the vaccine's not effective. Oh, darn. I don't want to smile about that. That's a horrible thing. But yeah, I mean, that's life. It's slightly more severe flu. But the world's, in fear. A real risk, though, right now is hyperinflation or rising interest rates. So we'll see what happens. Fred says he is retired. Did he sell all his real estate and stocks? So Fred, if you're talking about he being me, being retired would mean you would have stocks for sure. And you could also have real estate in retirement. You should have a breadth of assets. You should have a little bit of every single asset class in retirement. But am I selling all my real estate off? Yes, 100%. I will not be a landlord in 2022. Hopefully 2022. I might have one property still in 2023, but the goal is to not be a landlord anymore. I don't want to be tied to any tenants at all. I might still have a property that I Airbnb, and I will still be doing flipping. There will be partners that I work with. I'm not actively doing anything. I'm more of a money partner and helping with financing and sourcing. But yeah, I mean, I'm not really interested in doing anything actively. I don't even want to go to the properties anymore. I'm past that. Don't enjoy it. So yeah, that's my version of retirement. I do dabble with stocks. I will continue to do that. When I'm 90 years old, I'll be sitting there, on my computer dabbling. Yeah, it's just who I am. And that is, I think, a version of retirement. Not having to work and choosing to do whatever you want with your time. That's retirement. You could volunteer. You could pick up a hobby. You could trade stocks if you want to. You could do, real estate too if you want. You want to buy some properties, whatever. You can do that in retirement. Why not? Karan says, looks like a gamma squeeze to downside. Market makers have a lot of negative gamma exposure right now. Buckle up for a period of high volatility. The good thing about that, though, is that if I had a lot of liquidity right now, would be, and I didn't have all these equity positions, would be that just in general, if you're watching the market right now, what that means is there's a lot of premium associated with a lot of the underlying contracts. So if you're selling calls or you're selling puts, there's a ton of premium that you can collect as someone willing to insure and buy in this dip. And so you could stay 20% out of the money, which very unlikely that we'll see that far of a dip, and get paid very well right now. So there's a lot of opportunity, I think, right now to collect premium and not get assigned. So stay away from being in, like, people are like 5% away from the money. Don't take those contracts on. Like, you might get assigned. That's scary. Stay way out of the money, and I think you'll be good. Collect some nice premium without taking a lot of risk. Patel says, so because of the new variant, the market is going down. How far should we expect it might go down? How are your thoughts on real estate? Will it keep going, or can we expect some dip? Patel, I think real estate will continue, at least in Southwestern Ontario, where I am, will continue to, like slingshot to the moon. We're on a steady trajectory up. It's just the nature of the fact that we have a supply chain issue. There's a number of things coming together, but one of them is we have a supply chain issue. Like, you can't even get, even if you wanted to pay like $1 million for plumbing fixtures, you can't even get certain things right now. There's like 6-month back orders on garage doors, plumbing fixtures, lumber is hit or miss. A lot of the custom specialty stuff like wire to build new stuff and to add units and do construction is just either at a 200% markup or not even available to be ordered. Like, I want to put a pool in the spring, and we're looking at 6 months out just to get certain parts for the pool. That's the nature of construction. Is there's just right now there's a labor shortage of people that want to work. There's tons of delays as far as like inspections and things go, and backlogs from before, and then just getting materials is nearly impossible. So there'll be a supply side issue for a while as we continue to allow people to immigrate into Canada. We can't build enough to sustain the demand that exists. So there's a supply demand problem. Regardless of what's going on, there's a supply demand problem for available housing. That translates into good housing prices. We are also at all-time low interest rates, right? That's a challenge because it creates a lot of gas on the fire and makes more people want to buy. When you can, I just refinanced my house right now, today it came through, and my mortgage is a 5-year variable 1.27%. I just borrowed like well in the 7 figures against my house at 1.25% interest. It's like free money. I could literally take that money and pay off my other line of credit at like 3% and make money, right? It's a prime minus. Because it's so cheap, people want to buy. And there's talk of rising interest rates. There's talk that, inflation is not transitory in nature, which means they are going to have to do something, which means they're going to raise interest rates. How far can they go before the government feels it themselves, right? They have a lot of debt. A lot of the US, Canada, we have a lot of debt. And so that national debt is expensive to service. And if we raise interest rates and we raise the prime, it's expensive for the government to service that as well. Not only does raising rates crush the local economy, it puts pressure on real estate. What initially happens in real estate when you raise rates is there's an increase in demand. So what I see happening is we have a supply chain issue. We have heated demand right now. More international investors and just even Canadian investors want to get into real estate right now. And then we have, on top of that, low interest rates that are going to be potentially increasing into the near future, which is like pouring gas because everyone's locked in their 120-day rate holds as rates start to go up into next year. Next spring, everyone's going to have their rate hold, and they're going to want to use it before it expires. So they're going to go buy something, any property they can, and lock it in a 5 or 10-year fixed. And if you lock it in a 5-year fixed, you don't care what happens to interest rates because you're locked in. You can lock in a 5-year fix right now, like 1.7%. It's like free money. So that's going to pour gas on the fire of the real estate market into the spring. As I continue to sell off my portfolio, it's going to be great. We're in all-time highs. I wish I didn't sell. I sold half my portfolio of real estate off already. I wish I hadn't because the market continues to rise to new frothy highs. But I'm taking that capital and I'm putting it to work elsewhere. And at the same time, there's emotional reasons why I want to divest out of real estate. Real estate's a fantastic way to build wealth. There's a lot of stress that's associated with having 20, 30 properties, a couple hundred units. There's a lot that goes with that. Bad management you got to deal with, bad tenants and dragging you in the mud and all that kind of stuff, right? So I'm at a point where I know I can physically make more money in real estate. There's no doubt that is where my highest and best use of time is. And I still flip. I still find properties. I have a flip corp. I would continue to acquire undervalued properties that I see pop up. If someone brings me a deal at 60 cents on the dollar, I'm going to buy it and turn around and sell it at 95 cents on the dollar. That's just, I can't not do that. I won't actively be flipping it. I will have partners that do all the work, but I just think that For me, it's about reducing my overall risk and stress. And that means my time as well. So I can't have anything in my personal name. I'm looking to divest all my properties except for my personal property and cottage in my personal name. That's my long-term goal. Yeah, I think I will move assets into crypto, move assets into stock options are a fantastic way to generate cash flow. Private lending is okay too. It's a decent way to get some steady cash flow. I like to be more actively involved. Private lending is almost too passive for me. Like you set the money and that's it. I want to dabble a little bit. I like that with options trading, if I want to, could create a 12% interest rate product, so to speak, using options, and I could have no downside. Like I could literally build option spreads, or I could use I would use bull put spreads to do it, but on quality names and good blue chip companies that I like. But I can create that 12% return with no downside, where I'm stopped out and I can't lose money, and it's extremely liquid. I can close it tomorrow, like done. I have cash in my account. With real estate, it takes months to sell it and go through all the work and then negotiate it and all that. So it's, it just is what it is. I think that for me, it's just a personal decision. I respect the fact that real estate made me the wealthy person that I am now, and it is making a lot of people multimillionaires or whatever, and that there is a lot more juice to squeeze out, so to speak. But I don't know. For me, it's just an emotional decision, and I do believe that over the long term, using leverage, I can achieve more with less stress buying businesses and focusing on public equities. And I'm also at a point where literally when I sell my real estate portfolio and I invest it in public equities, I will make 7 figures in passive income for the rest of my life. Like, why do I need more than $1 million a year in passive income? I can't even spend 1/10 of that. Like my lifestyle, I could never, right? So it's just, at a certain point, it just doesn't even matter. I've gotten so lucky with appreciation and all the things going on that that's why I've made the decisions that I have. So Patel, the long answer to your question is I am very bullish on short-term real estate prices. I think inflation is another catalyst. Demand is a catalyst. International demand is a catalyst. Inventory and supply chain issues are a huge catalyst, pushing build prices to all-time highs. Labor shortage issues, again, a catalyst. Inflation tied to labor costs increasing all-time highs, a catalyst. Several catalysts for real estate prices rising. Inflation being, I think, one I didn't address enough of. We are seeing 6-7% real inflation. In some areas and sectors, it's 15 and 20%, depending on what you're buying, which makes me feel horrible about my stock portfolio losses because inflation's rising and my portfolio is down. That feels horrible, but that'll correct. I think those pieces will come back together. You can't look at the day-to-day when you're investing for the long term. You gotta be focused on that long-term horizon, and a 5 or 10% dip in your portfolio, you can't look at that. You've gotta be focused on the long term, and that's what I am focused on. So Mr. Pipton says, Tasty Trade is a great place to learn. It is fantastic. I watched the first 3 little episodes and it was fantastic. I wish I had the time to sit down and the concentration to sit down and finish it. I do want to sit down and finish it. Yeah. And Stock Hacker Academy is good too. Erwin Zito runs that program. Fantastic. I have a referral link if you're interested to check that out. It's a Canadian one. They have a really basic, entry to stock option trading where all you do is just sell puts. Basically, it's a version of Derek Foster's Money for Nothing. It's a great book, by the way, to read as an entry level to just selling puts. It doesn't get into the more complicated advanced trades, but yeah. Hey Ishi, how you doing? Next one was, Mike, what are your thoughts on the sustainability of the real estate market and most of the Ontario in general? Do you see Ontario investors allocating their funds at different provinces? There is definitely a lot of talk on the groups that I'm in Ontario, and there's definitely a pressure to go places like Saskatchewan. I hear a lot of posts about Calgary, the Alberta area just in general. Manitoba, there's some interesting stuff going on there. If you look at the prices of real estate in Alberta, Saskatchewan, Manitoba specifically Winnipeg. If you look at Winnipeg's a pretty big city. I think it's maybe top 15 in Canada. And they've seen like 7% appreciation. I think I saw, like, this is a while ago, but when they were seeing like 7% appreciation, we're seeing 30% here. So it's becoming wildly more attractive as rents are similar and prices are not going up in the same way there. So there's definitely going to be investors who say, look, you know, there's so many, like, I know so many people who had 5 or 10 properties here in Ontario, which is like not a huge feat. Like, a lot of people can get to 5 or 10 properties. And you know, that would have been like a $4 million portfolio that's now worth like $10 million. And so they've made $6 million in appreciation. Like, I talked to like dozens of investors who have made like $5 and $10 million in appreciation in the last like 5 years here in Ontario. And they're like, bam, they're like, at market value, my property has no cash flow. Why would I keep it? Why don't I sell it and buy some stuff out in, you know, in Winnipeg or something, right? Or maybe go to the US or whatever, where I can find double and triple the cap rates and better ROIs. Yeah, there's definitely a lot of that sentiment in the community right now. And I think that there's been a lot of people who have been just lucky. We levered up and the market did really well for us. You know, real estate prices are all-time highs. We invested with good fundamentals and, you know, made a lot of money. And so a lot of investors blessed. Do I think Ontario real estate will continue to rise? Probably. Looking in Europe, there are places in even Japan, but a lot of places in Europe where it's a renter's nation, where like 80% of people rent, and large firms or really wealthy people own real estate. They're happy with like 3% returns. The property value has been driven to places where the rent to price is like break even. And so we have a long way to go before we're there. There's still cash flow here in Southwestern Ontario, especially. Toronto, less so. There are properties in Toronto where you're buying strictly for appreciation, where there is no cash flow at all. You might get a little mortgage pay down. That's a not as attractive proposition. If you've got a lot of wealth, like, you know, if you want to speculate on real estate, I could see how that could make sense. But I don't know. Real estate in Toronto is getting a little crazy, especially in the core there. There was some dip during COVID that made sense, but I'm not that bullish. I mean, I'm bullish on prices in general in Ontario, but I've never been that bullish on the major cities. I'm less bullish on London now. There are still pockets in certain segments that I like. I almost exclusively avoid the A-plus properties only because they've just priced themselves out of cash flow. So I'm looking at the B and the C properties mostly these days. Next question. Seeing houses go for 200,000 over. Yeah, I mean, it's just wild right now, the offers and things. A friend of mine just sold their student rental near Fanshawe for like $775,000. That's wild to me. Like, that comp now we're gonna all see there is like near $800,000 for like a 5-bedroom or 6-bedroom student rental near Fanshawe. That like 3 years ago would have been 300 grand. Just ridiculous, some of these valuations. It's interesting though, there are pockets in the city where, near Western is a pocket of the city where properties used to sell for 250, 300. They're now selling for like 550. So they haven't even doubled. But in other areas of the city, we've seen prices have tripled. So within London, in certain neighborhoods, we're seeing a triple in the value. And in other neighborhoods, we're seeing not even a double yet. I see areas where it's the same price now as it was 9 months ago, a year ago. And so there are pockets where it can make sense. And there's a ton of arbitrage. The market is not efficient or perfect. And there's lots of opportunity all across the board. And that's one thing I love about real estate locally, is that it's not efficient. There's a ton of arbitrage. And that's key, I think, to making money when you're first getting started. Fred says, sorry, I knew that you were retired. I never thought of what you were doing now. So having seen you for a while, I misinterpret. So Fred, I mean, I officially quit my job and retired end of 2016, early 2017. I haven't officially worked any job really since then, not in an official capacity. I've had T4 income as the CFO of Choice Medical, as an example. You know, I've held roles, but they were loose roles because I was an equity holder. I didn't have to do anything as far as like a real job where I was actually accountable to a boss. So I haven't really worked for anyone or had the need to actually work for anyone because I was financially independent, meaning all my expenses are more than covered with passive income. So I don't need to work for anyone since 2017. So that's coming up on 5 years. Wow, we're almost 5 years into retirement, and my net worth is probably almost 10x. That's crazy. I wouldn't have expected myself to grow so much, but I guess when you free up yourself from 50 hours a week in a job you hate to having the free time to then explore businesses and opportunities, your time, you start making more on your time. Like, as a salaried employee, I made like what, 60 grand a year, and like my time's worth like 30 bucks an hour at 60 grand a year, right? Whereas now I make $500 an hour on my time. And so I put less time in and I get a way better reward. And there's also the money snowball. Like once you start rolling these giant snowballs, metaphorical snowballs down a mountain, and they continue to produce passive income and you don't spend it all, it continues to grow and grow and grow. And now I'm at the point where like I could never spend the passive income. I'd have to just invest in the dumbest shit to lose my money. That's the only way I would not be retired multiple times over. Hashtag blessed, you know, and you guys can get there too. It's totally doable. I'm not a special person. I work hard. I have worked hard for a long time, you know, a decade now, but you could do it too. You know, just tone back your living expenses and invest. Jen says, whoa. Hey, Jen. Fred says, where can I see a video where you explain the move away from your landlord ownership and towards flipping in equities? Do you think cash flowing commercial landlord ownership is also hassle-free? No, it's not. I mean, commercial landlording is less risky in the sense that you don't have a landlord-tenant board here in Ontario that is pro-tenant. But at the same time, you know, there definitely is that as a landlord, there's a responsibility there to a tenant. And so there's, yes, it's more passive. No, it's not as passive as like a stock portfolio, right? I will say this. I will say if cap rates improved on commercial real estate, I'd be interested in commercial real estate. They're just, the cap rates just aren't, all the deals that I'm seeing, you're competing against institutional capital. You're competing against people with dumb money. And they're okay, like almost all the commercial real estate is like 3, 4, 5, 6 cap rate. If it was 10 and 12, like I can still find that in real estate residentially. If I could find that commercial, yeah. The real cap rates are like 5 right now in commercial real estate. So after your financing costs you 3, on commercial financing it's like 3.5 or something these days. I don't know what commercial financing is, but more than residential considerably. So your cost of debt is a lot higher for commercial real estate, and your returns are squeezed to all-time low cap rates for commercial real estate because you're competing against everyone and their uncle. So it's just not that much spread there to live on, not much bread in commercial real estate. Yeah, it's easier, but the vacancy rates are really high as an example. So if you properly calculate vacancy rate, you properly calculate some of these additional expenses that exist in commercial. Like it can take you a year to find a good flagship commercial tenant. Whereas like I post a unit for rent and like a week later it's residentially, it's rented. There's a lineup of people begging to rent the units. It's different in commercial. It's hard to find a tenant. And if you find a tenant, that's all the value. And buildings without tenants are not that valuable. And so it's a different game in commercial. And yes, it can make a lot of sense. And yes, I'm interested if the cap rates are right, for sure. Oh, there's so many questions still here. I gotta wrap this up. I guess, Fred, to answer your question, if you watch all of my live streams, I continually talk about all this stuff, and I have for the last couple of years. If you have some place to go and are not tied emotionally, is it time to sell your personal residence and cash in? Jen, you know, I've continued to wrestle with the idea of like moving to the Bahamas where there's like no tax. I could afford a mansion with staff, like multiple staff to care for everything and care for my family, cheaper than just the tax bill for me staying in Canada. And every time I think about that, it makes me sick. So now thinking on it makes me feel horrible. There will be a time where I leave Canada. I'll be back here 5 months a year as a non-tax resident, visiting family and stuff, but yeah, eventually I will have to leave Canada. The tax climate here makes no sense. Last week I talked about how it's great if you make less than 100 grand a year in Canada, you can retire with eligible dividends, and I believe it's actually 60 grand a year. I was doing a bit of poking around. I think it's like 60K a year you can collect in dividends at like under a 12% tax rate. So like almost no tax at all. You could bring in like 10,000 a month in retirement. Unfortunately, I bring in a lot more than that. So Canada doesn't make sense because it's very onerous from a tax perspective to stay in Canada if you're a wealthy producing individual. But there are emotional factors that come into play too. So Fred says, did I miss the part where you explained switching mostly to equities? That's been a slow change over the last year. If you've tuned into my shows, it's I'm still gonna be involved in real estate and flip real estate and whatnot, but I will have no buy and hold property. It isn't attractive anymore. Commercial real estate in the States is 1 to 1.25%, so higher than residential by my experience. Interesting. What are your thoughts on private lending through third-party companies that lend against real estate? CMI has high yield funds paying 10%. They only lend up to 80% loan to value through like Olympia Trust. Daniel, yeah, I mean, it's a way to go. My caution right now with doing that is inflation. Another, consideration, I guess, with the Olympia stuff. It's solid. 10% isn't enough for me. I want to put in a little extra effort and make a little more. That's just me. Maybe a percentage of my net worth would go into lending. I think, you can put a little bit away into lending and it's a decent option. For me, I'm well connected in Ontario and I know a lot of flippers. And so I can find someone who will take my money on a first mortgage, 80% loan to value on a flip at like 16, 17% right now. So that's why the 10 isn't as attractive. But for someone who isn't connected like I am, that's a great option. It's hard to find a consistent stream of people. Like, let's say someone pays your mortgage back after 6 months. Do you have someone lined up the same day to take that money? Or might you have that money just sitting there for 2 months while you wait for another mortgage deal to come up, right? So there's pros and cons to lending. But yeah, I think lending can be a very lucrative business. I've considered it as well, versus options trading. I'm dabbling with both right now. And if I change my mind and go back to the lending stuff, I'll let you guys know. If inflation is in fact transitory, I will probably switch back to a lending business where I can gouge people in appraisal fees and lending fees and inspection fees and consulting fees, where I help them structure the deal. And there's a lot of money to be made on the lending space where you're working with flippers, where they're used to paying for a lender fee, they're used to paying for legal fees, they're used to paying for appraisals. And if you go and do your own appraisal, you can charge them $700 to go look at the property and decide if you want to lend on it. So there's lots of options as far as like appraisal fees and things go and whatnot. So yeah. Next one. Why not take a 10-year fixed at 2.6% with a variable rate risk? Will you no longer be an owner by 2023? So Fred, one of the considerations is I plan to either refinance or sell the property. And variable allows me to break out with no breakout fees. So that's why I like variable. 2, variable has outperformed fixed every single month, every single year for the last 10 years, 15 years actually. So fixed has lost for the last 15 years. Now, if we went through like a huge rate hike, that might not be the case. But even when we had a 1% jump in rates and a fall, variable still won. So I like to take the gamble on variable. A year from now, probably rates will start coming up a little bit, but I'll have had a whole year at 1.25. And what, it'll go up what percent? So I'll be at 2.25. Who cares? Like, for me, I think variable is a better option, especially because if you want to refinance. If you're on a fixed, good luck refinancing. I used to fix in everything, and I ran the numbers, retroactively into like a regression analysis and was like, geez, what was I doing fixing in all these properties on 5-year fixed? I was paying massive breakout fees when I burred and refinanced. If I sold a property and bought another one, I was getting crushed on the fees. So variable is much better, much more flexible. So I like variable, but fixed can make sense too, totally. You basically are trying to game out how much rates will increase, and has the market priced that in? Has the bank priced that in right now? I think they've priced in quite a bit. So, yeah. Fred says, the hassle of real estate, keeping them personally, using the Smith on that, invest in things, good plan for guy, not yet 30, says the 58-year-old. Oh, thank you for the comment. CK says exactly. David says, hi Mike, what do you think about real estate limited partnerships and commercial light industrial properties? Yeah, I mean, I don't have a ton of experience on how to structure that stuff. It almost always makes sense to incorporate commercial real estate just for the HST perspective alone. So yeah, commercially, you definitely want to open a corp and do it. But as far as like partnerships go, yeah, I mean, just you guys can both go on corp together. There's lots of ways you can structure it. You don't have to go on corp together, but that's one way to do it too. Yeah, for sure. Nice. Oh, Barad, thank you for that little troll comment. Do you think Sam beat real estate? I mean, clearly it didn't. It's down 60% year to date, whereas real estate's up like 15% year to date, unlevered. So yeah, of course that stock did not perform. let's look at the next 12 months. It's very possible that in the next 12 months it outperforms, especially because it's been beaten up so much, right? Crypto has definitely outperformed real estate for sure. I regret not buying Bitcoin at $3,500 a token last year and during the COVID drop. I could have bought, like 50 Bitcoin at the time. That would have been doable for me, no problem. Even 100 Bitcoin would have been doable. Imagine how much I'd have today if I just bought 100 Bitcoin instead of buying all that real estate. So yeah, I mean, that's like, we're talking like 2020, like April, not even that long ago. So there are definitely other opportunities, and I talk to people on my Instagram stories all the time. They'll reach out to me and like, oh man, I bought like Tesla like 2 years ago. I'm so glad I put like 100 grand into that instead of real estate. It turned out way better. So there's lots of people who do way better. The thing is with real estate is like, it's a consistent, safe cash flow every month. It's predictable. It's not like a moonshot. It's like, I don't plan to get super rich from it. I just plan to make a little bit every month and not lose my money. And the most important rule of investing is not lose your money. Hey, William. Matthew says, about to renovate an entire place in southwestern London. Any advice for a first-time large reno? Yeah, I mean, watch your contractors. Watch, labor costs get out of control. Watch your material costs, they get out of control. Good luck. It's a lot of work. Good luck. Badgery says, does it make sense to do options trading just during the weekend alone? You can't do options trading on the weekend. The market is open from 9:30 to 4 every day. So like, I only check my phone from 9:30 till 11, and then, I'll check it again in the afternoon. So options, futures, stocks. Yeah, I mean, it's tough with a full-time job, obviously. Matthew says, afterwards, the plan is to turn out our current into a duplex. Any advice on permits? Yeah, I mean, you're going to have to get permits to convert to a duplex and do all that. If there's structural stuff involved, of course, I recommend getting permits. Just getting the drawings together and getting a BCIN stamped will probably take you back and forth a month. And then when you submit them, if you're lucky, they'll respond on the 10th business day, which means you're 3 weeks. So you're at 7 weeks now. And then what they'll do is on the 10th business day, they'll respond and they'll say, oh, we're missing a measurement here. We're missing this, we're missing that. Send it to your BCIN. And because they're so backlogged, they'll just pick something. I've been talking with a bunch of people who submitted like 10 different permits, and all of the individual people I was talking to, they all came back with feedback, was like, oh, this is missing, that is missing. They're just picking something. And sometimes it's even literally it's just on the drawings. In one case, I had a permit submitted, and they were asking for something that was literally on the drawing. I responded back, I was like, look on the drawing, it's right here. And they're like, oh, didn't see it. Took them 21 business days to respond, oh, I didn't see it on the drawing. We're talking months. 21 business days is like a month and a half, right? Or a month and a quarter. So once the 10 days have passed, that they have to respond to you within 10 business days. Then after that, once they've come back with a deficiency, they can take as long as they want, up to a year. So I've seen permits go months and months and months before being addressed. But suffice to say, if you had a really good contractor and you were able to get your inspections, and you had really nice inspectors who didn't nail you on deficiencies, and you had a really great plans examiner who examined all your plans, probably start to finish for any renovation, 3 months. That's like the fastest you could possibly do it. Real life for a first time person, 6 months to a year, more likely. So prepare yourself for a year. That's the real life. That's the sobering, unfortunately. That's probably not what you want to hear, but that's what I'm seeing in the real world, is it takes like a year. People don't factor in that a year opportunity cost on these big renos is a lot. Better to stick to cosmetic renos. Yeah. Danny says, how was your trading day today? It started out really great. I was up $70,000 this morning. And by the end of the day, I was down $60,000. So I had a $130,000 swing through today, which is painful. Oh, as a frugal guy, it really hurts to see those big losses, but it'll be fine. I know a year or two from now, I'm going to be way up. And I know even a month from now, I'll be way up. So I always just put it in perspective, like, is the stuff that I'm holding right now stuff that I'd be willing to hold for a year or two? Do I believe in it long term at the current valuation? Yes. A lot of the names, I have like 50 positions in that stock option portfolio right now. And like 45 of them, I love those names. So yeah, if you follow my stock trading group, you follow me on Instagram at Mike Rosehart, you'll see a lot of my daily trades. I can share stuff there for you guys to see. I sold covered calls on my SAM this morning, and I made $8,000 by the end of the day. So literally just on the shares that I'm holding, on that equity, it is down, but I still covered calls on it often, just trying to get the shares called away maybe, but like whatever if they don't. And today, because it dipped after I sold them at the high, it dipped, again, like almost 6, 7, 8 grand, something like that, just on one contract. That's cash flow on equity I'm already holding. So I'm gonna hold the shares either way until they improve, but I'll continue to sell covered calls on them. I can close those covered call contracts out, and it's basically like insurance, right? I can basically make money. It's cash flow beyond the dividends. So I love options as a way to juice up your portfolio and get a better return on stuff you hold anyway. So yeah, thanks guys for watching. Really appreciate you. And I'll see you on Instagram at Mike Rosehart. And you know the secret to unlocking wealth through you is, most importantly, spend less, earn more, and maximize returns in the difference. Once you've built up a portfolio, you got some wealth going, then it's important to look at, maximizing returns, finding ways to make more money, and then, spending less doesn't matter that much. Once you have a great earning, it's more about what do you do with all that wealth that you now are accumulating and all that money you've saved, how do you put it to work? Because a 1% return difference on $1 million is 10 grand. That's a lot more impactful on $1 million than trying to save $10,000, right? So saving becomes less important the wealthier you get, but at the start of your journey, it's the most important thing. You need to be living on at least, or at the most, half of what you earn. That's the secret to fire. Like, no matter what you're doing all around, whatever you make, take half and put it in investments, save it. Put some in crypto, put some in some quality stocks, real estate, whatever. Businesses, invest in side hustles, whatever it is, but take some money and put it aside. I've always believed 80% of what you make, you take it aside, it's not yours, it's gone. 20% you live on. You find a way to live on 20% of what you make. And then as you make more, you find a way to live on 10% what you make. Then you find a way to live on 5% of what you make. That's what I do now, I try to live on 5-10% of what we make. And that is a good recipe for continuing to build wealth. That's a great recipe for never running out of money, for always staying in retirement and then getting to retirement as well. So, all right, everyone, thank you so much for watching. We'll see you next week. Bye.